Hello and welcome everyone to another session of C4S classes where we are discussing MCQs related to finance. Okay, so first question on the screen is which of the following is a key objective of the fully accessible route introduced by RBI? Okay, so options are given on the screen. So in first option, it is written that to allow foreign investors unrestricted access to certain government securities. Next is to enhance liquidity in corporate bonds for domestic institutional investors. Next is to promote financial inclusion through better rural banking access. Fourth is to reduce the fiscal deficit by privatizing government securities. And fifth is to introduce new tax regime for foreign portfolio investments. So the correct answer for this is A, that is to allow foreign investors access to certain government securities. Okay. So why is this in news? That a news article came where it is saying that this FAR has received, so FAR Securities received 60,000 crore inflow. So since our government bonds have been included in the JP Morgan index, 60,000 crore inflows has been taken place. So FPI investments in FAR securities has had doubled, surpassing the 2 trillion marks. So this figure is also important. They might ask this figure also. Okay. Within 9 months of the announcement of JP Morgan, including Indian debt in its index. Okay. So this FAR was established by RBI to attract foreign investors. Okay. So here basically what they are doing, they are attracting FPIs, foreign portfolio investors, to invest in our government securities. Okay. In our government securities. And here they want that FPIs should stay for some time, let's say 3 years. Okay. Because the habit of FPIs are that they they are a kind of hot money. Hot money means that can move quickly. So they can move in a country quickly as well as exit from the country quickly. So to involve FPIs in government securities is to curb this, you know, fast flow, fast inflow as well as outflow of money. So they want these FPIs to invest in government securities. Okay. So this move aims to broaden the investor base and boost liquidity in India's debt markets while aligning with India's commitments under international agreements. Okay. Now moving on to next question. What is the minimum allocation of the issue size required under SEBI's liquidity window facility for debt securities? So SEBI has given a SEBI has, proposed a liquidity window facility for debt securities. Basically, it is a kind of a putable bonds. Putable, what this means? That means you can have an option of, you can have put options on bonds. So that means at any point of time, a certain security, debt security that a person purchases, it can be sold back to the issuer. Okay. Here we are not talking about trading the security. Here we are talking about giving it back. So here the question is asking what is the minimum allocation of the issue size. So let's suppose if 100 crores is the issue size, then what should be the minimum allocation for liquidity window facility? So the answer is 10%. So in this case, 10 crore would be the minimum facility that has to be given by the issuer. Okay. So here it is saying SEBI introduces liquidity facility, window facility for investors in debt securities. Okay, so it is a special case where only debt securities are concerned. So this liquidity window facility allows investors holding listed debt securities to sell them back to the issuer using a put option. That's why I'm calling it, or in the news, it is being called as putable bonds. Okay, so this is a new term. So here in the explanation, it is written that the facility applies only to listed debt securities, and securities under this scheme cannot be reissued. Okay, this is another important thing. At least 10% of the issue size must be allocated for the liquidity facility Each window will remain open for 3 working days with notifications sent annually at the start of the financial year to inform investors of the schedule. Okay. So only 3 working days window will be there where a person can sell back his bonds to the issuer, and the minimum amount that is available is only 10%. That means above 10% and 10% window of liquidity can be made or provided by the issuer. Okay. Now, moving on to next question. Which financial institution partnered with Axis Bank to provide 500 million loan for developing a blue finance market and scaling up green projects in India? Okay. So here in this case, the answer is International Finance Corporation. Okay. So it has extended a 500 million dollar loan to Axis Bank to fund green projects. So why this is important? This is important because this is IFC's first blue investment in India. So what is this blue investment? So blue loans specifically target sustainable projects that address water related environmental challenges, contributing to India's broader green and sustainable development efforts. Okay. Now, before moving towards the next question, it is just a reminder that our UIIC AO exam test series is live. You can find the test schedule on our Telegram channel as well as on the website. Links are given here. Okay. Now, moving on to next question. What is the primary purpose of a bond buyback auction conducted by a government? First is to increase interest rates on government bonds. Next is to reduce the overall debt burden by retiring certain bonds. Next is to issue new bonds in place of older ones. Next is to stabilize the stock market. And fifth is to introduce more short-term debt instruments. The right answer is B, to reduce overall debt burden by retiring certain bonds. Okay. So why this is in news? That RBI conducted a government bond buyback auction worth 25,000 crores on October 10th. Okay. So this is a process where a government repurchases its outstanding bonds before their maturity. This helps in managing the country's debt profile by retiring high cost, less liquid debt and replacing it with newer, often more favorable instruments. Okay. So basically government is trying to, decrease its debt load. So it is a debt management strategy aimed at reducing future liabilities and enhancing market efficiency. Okay. Now, last question for this session is, what is the enhanced life insurance cover provided under EDLI, that is the Employees Deposit Linked Insurance Scheme, as announced by the Government of India? So basically this insurance scheme is under Ministry of Labor and Employment, and the institute that takes care of it is EPFO. Okay. So all the EPFO members are provided with this scheme. Okay. And there are certain guidelines there. So here they are asking what is the enhanced life insurance cover. So the answer for it is C, 7 lakhs. And this question was asked in IFSC mains also. It was in different framings, but basically they were asking the amount. So this year IFSC mains 2024, they asked this question. Okay. So here they are saying that this insurance benefits will be acting retrospectively. That means let's suppose 22 November, right? So when we are saying retrospectively, that means the benefits will be applied from a previous date. Here they have given that previous date is 28th April. Okay. So now the scheme is providing insurance up to 7 lakhs. So the insurance covered by under this scheme ranges from 2.5 lakhs. It is the minimum limit, and the maximum limit is 7 lakhs. Okay. And it will be effective retrospectively from 28th April 2024. So that's all for today's session. Thank you and have a nice day.